Some YouTube commentators have come out to say that part of the reason why Disney is in trouble is because they've embraced woke policies, which is resulting with their movies flopping and fewer people attending the parks. And I want to investigate that and see if it actually is the truth. And so, guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, a large YouTuber who I actually like recently put out a video saying that, and actually I'm just going to show it to you, saying that Disney collapses as parents refuse to attend the park and go to what he describes as the woke movies, causing them to lose $300 million and counting. And so, I wanted to investigate this because the Disney stock is actually starting to look cheaper and cheaper. And so it's something from a value investing perspective that I thought, okay, you know what, this might be interesting to investigate. And of course, my biggest contention with Disney, and I'll explain it further in this video, is that they have a parks segment and they have a media segment. So Disney has two major segments that you have to be aware of, and you guys are already aware of these segments just loosely anyways, without even looking at the financial statements. You know that they create media, which is their movies, and they have TV networks, etc., and then they also have their theme parks and cruise ships and etc. And so that's that second segment. And part of owning a media segment is it's inherently risky, and you can see that if you have creative struggles, it could prove costly at the box office. Now, one of my biggest areas of contention is, look, I was actually one of the people that enjoyed the prequels to Star Wars, and I know I'm a rarity, but I really liked the writing. Could have been a little bit better, yeah, but I was really worried when Disney took over Star Wars because I just didn't think that they would be able to improve the writing. And what ended up happening is that actually ended up being the case, especially with their trilogy. I mean, there was one movie or maybe two movies that were somewhat okay, but the trilogy definitely suffered. And this is kind of what you get when these large corporations with these large budgets purchase these entities. I don't think they become more creative. And so it's something that you have to be aware of. Now, are these franchises flopping as a result of woke politics? Maybe. I don't think it's significantly because of that. I think the bigger issue is that it's just lacking creativity. Can you shoehorn in some woke politics while keeping it somewhat creative? I don't know. Sometimes it could take away from it. And so I would kind of like stay away from politics anyways as it comes to creating these movies. But I think the larger issue is that, you just don't have the writing in this environment, and so that's why many of these movies aren't doing well. Now, some movies that are not that creatively written do well. I mean, a lot of these like superhero movies that have been coming out, especially from Marvel, some of them are not really that unique, and yet they still generate millions and millions of dollars. And so sometimes a lack of creativity from the writing department still gets rewarded. And so part of it is the fact that they have been rewarded for so long with not really creating anything unique in the movie space. And so that might be part of this issue. But, as far as I'm concerned as an investor, it's really difficult to forecast the direction that this segment is going. And so that's why I've largely stayed away from Disney as a stock. And the Wall Street Journal just reported that, there are shorter wait times for rides and there's more discounts being offered as a result of the thinning crowds at the theme park. Now, is this because of what the quartering said, which is that parents are refusing to send their kids or take their kids to Disney, or is there something else going on here? And one of the things that might lead to people concluding that there might be some sort of backlash against Disney is that the top S&P 500 stocks in June, this is a slide that I provide on our monthly calls to the Patreons, and so this is a slide that they actually saw this month, is that the top winners in June were actually travel stocks. So you can see Carnival, Norwegian, Delta, Southwest American, United, Royal, Alaska. And so, it was really the month for travel stocks. But one name that's missing from this list, of course, is Disney, especially considering that they have such a large a travel segment, which consists of the parks and the cruise lines. And so the question is, what's going on there? And of course, before I move on, I do have to say, just because the stocks are going up doesn't necessarily mean that the company has made a ton of money in that particular quarter or that particular month. But what it speaks to is the directionality of optimism within that organization organization's capability of generating income. Now, the other issue could be that, Disney is just valued significantly higher, and so it didn't have much room to run up, whereas some of these other guys were not valued as high, for example, Norwegian and Carnival. And so just keep that in mind when you look at stock price performance and you're trying to provide rationales for certain things. And so what's really happening? I really think what's happening is that they raised prices during the pandemic. And so now your audience actually remains below the pre-pandemic levels as a result of that pricing increase. And the fact that they're charging for services and features that used to be free. So I think parents are looking at the total cost of a vacation to Disney, comparing it with other competitive opportunities, for example, vacationing in Europe or going on cruises that are not Disney related, and deciding to go in those directions, especially in an environment where people's pockets are more pinched. And so I really think that this is a pushback to pricing policies as opposed to anything political in nature. Now, I know some people will say, hey, look, there are some families that are likely to boycott Disney due to their involvement in woke politics. And I would offer you an olive branch and say, yes, you're probably right that there are some families that are deciding to not go to Disney as a result of their foray into the political landscape. However, I question how material it is, and I will just leave it at I'm not really sure how material it is, because at the end of the day, if you have a bone of contention against the company as a result of their political leanings, is that really a good enough reason to deny your children their dream of going to Disney World? I don't know. Personally, as a parent, if my kid really, really wanted to go to Disney World, I don't know if I would say no to that, but I would say no if they had raised their prices and there are other competitive vacation type opportunities. And so, I don't know what the answer there is, but I suspect that the people that are boycotting Disney as a result of this are immaterial to the overall group of customers that the company has that go to these parks. And you can see in the Wall Street Journal article that I showed you earlier that pent-up demand has somewhat transitioned to cruises and Europe. And Disney doesn't have major new U.S. attractions that are opening soon that would draw people in, apart from a reimagination of their Splash Mountain. And that's a very good point that they're making. In the Peter Lynch books, one of the things that he did say when he would invest in theme parks is that whenever they open new rides, you would see a surge in revenues. And so he would try to generally get in before that, and then he'd see the surge in revenues and it would inevitably take up the stock price. And then, of course, in the seasons where they didn't release new rides or new attractions, revenues would dip. And so it's just something to be aware of. And it's just something very interesting here because, yes, there's nothing really new to really check out at Disney. And so I think, if they invest a little bit more into those parks, maybe even bring down the prices a little bit, I think you can resurge the number of people coming to the parks. And you're starting to see that already, where they are offering discounts for one of their busiest times of the year, which is that December period. And you can see that here. To attract more visitors to Main Street USA, Disney has rolled out promotions including discounts for return visits and savings of up to 40% on rooms at some Disney World hotels for annual pass holders on certain days in December near Christmas. They're also announcing that they're going to bring back the dining plans that allow visitors to prepay for meals. These plans were super popular with Disney diehards, and they were suspended in 2020. And so I think these are moves in the right direction. I think you are going to start seeing the number of people frequenting the parks increase. And so once again, I think this is more a price related pushback as opposed to a political related pushback. And so diving into the financials a little bit, you guys will know that on the tracker, I am following Disney. There's a lot of companies that I'll follow. I'll follow them for like 20 or 30 years and never buy the security. And this might just be one of those. And so you can see that if you click into this tracker link right here, I've hidden all the other names because it's just available to the patrons. But if you click into this, this, we get into their model, which I'll show you in a second. But first, I just want to remind you guys that, you can get access to years and years of my research right here at this lower tier. And there's around 200 Patreons or so at the moment that do have access to the tracker. And what do I mean by getting access to the tracker? Well, you get access to models like this. So for example, this is the Disney model. And so these were the two segments that I was talking about. So you got your revenues right here, you got your segment operating income here, and then of course I build out the P&L below here, and this will roll all the way down to EPS. There's a balance sheet, there's a cash flow statement, et cetera, et cetera. And so, this is what I was talking about. This segment right here, the Disney Media and Entertainment Distribution segment, this is the big unknown for me. Streaming, which I haven't even talked about in this video yet, is very hard to predict. So are the movies. It's very hard to predict whether or not the movies are going to start doing well either. They've been struggling as well. And so I've given them a 3% segment revenue increase or growth factor into the future. And that might be low, but it's very uncertain. And so here's where this last point that I want to make is that pre-pandemic, Disney had a gross profit rate of 45%. And, I'm factoring in 45%, but I'm also saying that this is excessive and it might be too much. And so I'm asking the question here, can profitability return? I'm not sure, especially if they're losing money on not just their movies that they're releasing, but they're also losing money on the Disney streaming service, and their parks are less profitable in the current environment. And so because they have to offer discounts to get people to come back. And so I don't know if they can return to this gross profit level. And so for those of you who do have access to the model, or for those of you who have models that you've built out on Disney on your own, let me know what you think about profitability going forward. Should we be forecasting 45, or should we be forecasting something closer to 35, which is relatively in line with the last 3 years, but I would say that the last 3 years are anomalous years. So you guys let me know. And for those of you guys who are not aware, Disney Plus does continue to keep growing. I think Disney Plus is the one streaming service that offers something unique because you can get access to the Disney catalog. But despite the growth, the road to profitability still remains uncertain. And so it's just something that we have to stay aware of. And this is what the valuation looks like. And arguably, I would say that this is a high valuation because I've given them higher than what I think is appropriate for the gross profit figure. But the reason why I wanted to do that was just to show, like, in a perfect world, what would this company be worth? But in a reality world, and actually at the end of this, once I'm finished recording this video, I'm probably going to reduce that gross profit margin. But just, at that gross profit margin, you still see that the share price as a percentage of its intrinsic value is pretty high at 90%. I generally don't like to purchase these things unless it's a low price as a percentage of its intrinsic value, or I'm getting a high equity yield. In this case, you're getting neither. So this is not 50% of its intrinsic value. So it really has to grow into that. And the equity yield is low at 3%. And all this is the current share price divided by the expected earnings per share. And so, the current multiple is 33 times earnings, or next year's earnings. And so, 1 divided by 33 is at 3% equity yield. So, not super valuable, but I'm also using a low terminal multiple. A lot of people may not necessarily like the fact that I use a 15 times terminal multiple. You may want to use 20 or something. So let me know what your valuations say. Are any of you actually finding that Disney is cheap in this environment? I'm not seeing that it's cheap, but I want to know what you guys think. Let me know in the comments below. Now, Disney may not be hurt as a result of their foray into the political landscape, but there is one company that is suffering some decline as a result of that very issue. And I speak about it right here.